This is the Tesoro AI podcast with Darius Gant. AI is changing the world and fast. This episode is coming to you courtesy of Tesoro AI, the #1 recruiting service for software development and AI talent.
All right, Marlon, welcome to the show. Appreciate you taking some time out to join us.
No, Darius, thanks for having me on.
Absolutely. So I know, if founders are tuning in, if other investors are tuning in, they may have heard your name. You've been in the VC space for a while now, but we'd love for you to give folks more context. I mean, was there a career prior to VC? We'd love to get some more context into your professional career up to the point where you founded MaC Ventures.
Yeah, so I'd say my career was in 3 parts, or has been in 3 parts so far. The first part was, or the first leg was, I was an operator, really early employee at an enterprise software company out of Cambridge, Massachusetts. We were doing supplier relationship management software, and I led kind of global implementations ultimately for that company. And after raising the seed round, we saw a lot of growth and was getting a lot of attention. So I ended up moving to the UK, lived in the UK for 2.5, 3 years, building the company there. Ultimately, that company was acquired by SAP, and that's when I started my second leg of my career, which was in consulting. So I moved back to New York, actually, and got into post M&A integration consulting with the Blackstone Group. And from there, kind of did a mini transition to strategy consulting, working with media and entertainment companies like Warner Music and McGraw-Hill, as they were trying to navigate what was at the time becoming the proliferation of the internet. So you can imagine on the music side, trying to figure out, how you combat piracy if you're, on Warner. And on the publishing side, if you're like McGraw-Hill, Amazon was coming and ebooks were coming, and there wasn't such a big need for physical bookstores. So how do you fit in this new digital world? So that was kind of the job. Ultimately, I decided I didn't want to operate one entity, like one company, and I didn't want to just be a consultant.
Right.
I wanted to have some skin in the game, whatever it is that I was going to be doing. And so I just started like doing some research, talking to some trusted advisors and mentors, and stumbled upon venture capital. And I was like, yeah, I think this is what I want to do. So I ended up going back to business school. I chose Cornell for that.
Okay.
Primarily because it had an MBA-led pre-seed venture fund. And I became the CEO of that fund for roughly a year and a half of the 2 years that I was there for business school. And that's what helped me to kind of get some reps in the business of venture and build a relationship with other folks that were working in the field. So ultimately, I graduated and joined Intel Capital.
Okay.
And this was in 2011. And at that time, it was, I guess you can consider it Intel Capital's heyday, where we were investing anywhere between 200 and 500 million per year in Series A, Series B companies primarily. And so it's a great place to learn the business of venture and get a lot of reps.
Right.
And so did that, became a Kauffman Fellow during my time there. And that kind of opened my eyes up to a lot of things.
For those who aren't familiar with Kauffman, what is?
Oh, it's the largest global network of venture capitalists in the world. And it starts out with a 2-year, call it residency or program, where you're learning different aspects of venture from, the premier leaders in the space. So there's like a 2-year curriculum. And then from that, we call it vesting. Once you vested, now you're fully ingrained into the global community of close to 1,000, investors around the world. So yeah, and so while going through that, my eyes were opened. I was like, this is something that I could build on my own, right? I can come up with the thesis and build this firm, and the economics would be vastly better than economics at a corporate VC. The types of deals that I'd be able to invest in would be closer aligned to the things that I value and like. The types of founders that I would be able to invest in are the types of founders that, I want to spend the next 10 years working with and building relationships with. And so I decided to step out and create my own firm. And my first firm was called Cross Culture. and I built it alongside a good friend of mine, Troy Carter, who was a famed music manager and angel investor. And we built a pretty good brand, over the course of, let's call it 4 years. And then it was time to think about, okay, well, what's next?
Mm-hmm.
And I wanted to build a larger, I should say, venture capital platform that could span generations if we do it right. And Troy wanted to do another startup
Mm-hmm.
focused on music, which is what he knows. So I took the brand and was trying to figure out, okay, well, how do I scale this thing up? And as I was having those thoughts, I started to have more conversations with my now partners who were running a similar size firm called M Ventures in Los Angeles. And so I just put it to them one day because we were looking at so many deals together, and a few of us had known each other and been friends for a while. And so I said, hey, what if we just, kind of combine forces, put our teams together and go off and try to raise a larger vehicle and build from there. And they were into it. And so we tested it out and then went to market with MaC in 2019.
Nice.
And since then, we've raised three funds. We manage roughly, 600 million in assets and are, it's just building.
Nice. And I want to go back to, your kind of when you decided coming out of Kaufman Fellows, hey, this is something I could build on my own, right? This is something that I can, start as a founder. You had some experience, right, with strategy, M&A integration, as well as VC. As you think about the different types of entry points into investing, you could be private equity, you could be growth equity, or you could be on the VC side. How did, was there something about VC that you preferred compared to those other styles of investment? Or was it, hey, look, I've got a ton of reps in Series A and Series B, right, through Intel. So, let me continue pushing forward on that.
Yeah. So, why VC to begin with, right? So the what I learned about myself, right, because it's a continuous journey of learning, is I did enjoy working inside a startup, right? But I didn't enjoy working with the same product day in and day out. I didn't enjoy necessarily interfacing with the same customers day in and day out, right? So
Mhm.
that's why I was like, after that stint, I chose consulting because I'm not, all right, I can get more breadth,
Right.
right? And
Right.
so, and I did to an extent, right? It's limited though, because the way that consulting works is it's all about billable hours.
Mhm.
And the higher that you can get billed out for, that's where you're going to spend time. So it ended up being, oh, now I'm not seeing the variety in the types of, clients that I'm working with because now I'm considered an expert in this space, right? And so I wanted the variety, but what I did like about consulting was that I was working with executives that were decision makers. And we were having, deep strategic and operational conversations
Right.
about growing the business and things like that. And I really enjoyed that. The other part about consulting that I didn't enjoy is not being around for the ride,
Okay.
right? Because your engagement is for a specific moment in time. You
Right.
come in, you do that work, you go away, and you hope that they follow through on the things that you worked on together, but you don't know. And
Mhm.
so for me, venture seemed to bring me all the things that I enjoy and kind of put the things that I didn't much care for to the side. So specifically, I work with some of the smartest people in the world. They
Mhm.
are the decision makers within the entities that they're building. I engage with them on go-to-market strategy, operational strategy, growth strategy, all those things on a continual basis. There's a variety in the companies that I work with. So I see a lot of different technology. I see a lot of different industries, sectors, et cetera. So I'm getting the variety. And I'm committing to once I decide to make an investment, I'm committing to 5, 10 years at
Right.
least of working on this project with these founders. So it just seemed to fit all the boxes for me.
Mhm.
And that was my thesis coming in. And so far, it's proven to be correct.
Yeah, and you referenced your thesis. I'm curious for MaC Ventures, what's the thesis? What are the types of companies that you all have decided to invest in, and what are you seeing within, why are you excited, I should say, about that thesis?
Yeah, so Well, let me introduce MaC first,
Yeah.
and then I'll get in. So we're a seed stage venture firm. The bulk of our team is here in Los Angeles. I have one partner that's based in Menlo Park as well, but we invest primarily in North America, the United States primarily. I'd say about 50% of our deals are in California. Another 40% is splattered throughout the US, and then about 10% are international, and specifically Kenya, Nigeria,
Hmm.
Mexico City, Canada. And, in terms of a sector focus, we don't have one. We like to consider ourselves as a generalist firm being run by sector experts, right? So, we've invested in, fintech companies, B2B SaaS companies, digital health companies. One of my partners is heavily focused on space and defense. So, like, we have a rockets company in the portfolio, a lot of stuff. We invest in AI. I'd say the common thread for all the investments that we do, though, is that we're investing where people are going to be spending and businesses are going to be spending their time and money in the future. And so if you kind of reverse engineer that and put a label on it, it's popular culture, right? Because popular culture is essentially a group of behaviors that have become part of social norm, pop culture, right? And so we try to identify these trends and these behaviors as early as we can, right? Get a lot of data around, why this is going to be a thing going forward. And those are the types of companies that we're looking for.
Yeah, interesting. So if I'm thinking about this as a founder and really trying to define whether I fit within the thesis, right? Because sector agnostic, okay, well, that I fit that part, but you could go from pure software to tech-enabled services to services. Are you across the spectrum within those types of business
Yeah.
models?
You shouldn't expect to see us in a lot of CPG companies, like
Okay.
consumer product goods companies. You shouldn't expect to see us in services companies, tech and tech enabled companies for sure. And that could run across a number of sectors. So it could be, different B2B, focused things, or it could be even consumer facing, right? Like we have a new kind of social network or social platform called Spill on them as one of our investments. On the flip side, we have kind of a new way for small and medium-sized businesses to finance their working capital needs. A company named Pipe, for instance,
Mm-hmm.
or we have a company in the prenatal postpartum healthcare sector named Mommy. So there's a lot of different things, but all of those things are essentially software companies, right? With a different focus.
Yeah, interesting. And then the last thing I wanted to ask you about was kind of the strategy. So, historically, right, VCs were writing the same types of equity checks, but now you've seen some other strategies like revenue-based financing and whatnot. Have you all tapped into that, or you kind of hyper focused on the kind of preferred equity type investments?
Yeah, we're equity investors. So, we will underwrite safes and convertible notes, but at the end of the day, it's about equity, it's about ownership and helping those companies to grow. So to start a relationship, we'll invest up to 3 million and we'll target somewhere around 50%, can go as low as 10% in terms of our fully diluted ownership when we start the relationship. And
Mm-hmm.
then we'll continue to invest across one or two rounds after that in our, strong performing companies.
Yeah. I wanted to get your perspective. I mean, with MaC, right? Three funds managing 600 million. You also built Cross Culture Ventures, so has some experience successfully fundraising. Now, I think the statistic is that in terms of underrepresented fund managers, we've had the most that we've ever had, right? And there are also others that are out there, trying to get that first fund raised. So, just given your experience having raised funds, well, one, does the world look a little bit different from the perspective of fundraising? And two, what advice would you give someone who is trying to raise a first fund?
Yeah. Does the world look different? Yes. Right. I mean, just from, 3 years ago, the world looks different, right? When, coming out of the George Floyd tragedy, there was a ton of investment dollars targeted at diverse or underrepresented fund managers, right? Today, there's an attack on diversity in a significant way. And a lot of those corporations that made pledges are pulling back from that, right? And out of fear or whatever. So, so so it is different, right? The other thing is, man, the market in and of itself is different. A couple years ago, we raised our second fund in 2022. It took us 6 months, to raise a little above 200 million for that fund, right? Today, we're hearing a lot of our peers that have targets have to pretty much cut those targets in half just to have a successful fundraise, right? And that has to do with, where interest rates were versus where they are now, right? Essentially, it was free cash back
Right.
then. And then in addition to that, there hasn't been a ton of liquidity in the market because of the kind of the right sizing around valuations of later stage private companies. So, with a lack of or limited M&A outcomes and IPOs, the limited partners, our investors, they're kind of pulling back on deploying more capital to the asset class until they can start to recoup some of the capital that's already been out there. And so all those things make it a little bit more complicated or challenging for new managers in particular, right? If you're an existing manager and you have a base of institutional investors, then, and you perform well, then you're likely going to be okay, right? Those investors are going to continue to work with you because they want to continue to build a relationship, right? They don't want to be locked out of your next fund, for instance, right? If you're starting from scratch, you don't have those investors, right? And if they have those investors, they have hard choices to make, right? Like, do I back this new talented group here that I think is going to perform, or what? And I have limited more, my dollars to invest are more limited than they have been in the past. Or do I go with the thing that I know? I have some high performing managers in my portfolio already. I might as well just continue rocking with them until things turn around. So it's a much different environment for new fund managers, but it's not impossible, right? If you have an interesting background, you have a track record, you're building something that resembles a real institution from an operating standpoint, and your approach to making investments and finding deals is novel in some way, and you seem to be the right team to pull that off, you can raise. So it's not impossible. It's just a little bit harder. It's going to take a little bit longer.
Right. Any thoughts on kind of so if I'm a first fund, right, probably going to be smaller, but in terms of the universe of potential LPs, there are folks who only write huge checks. There's folks who can only write small checks. And then also just thinking about, well, first fund, I'm probably not going to have exits, but I'm going to have to go out and raise the second fund before before I've got realizations in the first fund. And I want to have my LPs follow along with me, kind of a lot loaded into that question, but just in thinking about as a first fund manager, how should I approach this universe of potential LPs and what may be kind of a thoughtful strategy to doing that?
Yeah. So, I mean, if you're raising like a $10 million fund or a $20 million fund, it probably doesn't make sense to target institutional investors, right? You don't want to target pension funds and fund of funds and or even large university endowments for that matter, because they have a certain size check that they need to write in order for that investment to make sense for them. And your fund size is probably the size of the check that they need to write. So that conversation is not going to go very far, right? I encourage you to start to build relationships with them now, right? So that, when you raise your second fund or your third fund and it's larger, and now they can actually deploy the check that they want to deploy. And also they usually have different mandates where like they can't be above, say, 10%, 15% of your entire fund, right? Because you could say, all right, my fund size 20 and you can write a $20 million check. All right, let's go. Right? No, nobody wants that level of risk either, right? So on both sides, by the way, because they decide they don't want to rock with you on your next fund,
It's over.
you're only investor, right? And on their side, it's they're the only ones there to support this vehicle. So yeah, so you probably want to target, family offices, which are difficult, by the way, because it's almost like a black hole. Like you don't know who they are, who the families are, how to get in touch with them. And so you've got to do a ton of networking around that just to get there. And then I'd say high net worth individuals, you probably want to target for these first funds too, which again adds to that narrative of, it's going to be difficult right now, right? I'm a high net worth individual, if I'm a high net worth individual, and, I have some cash and some maybe real estate, I have some in some businesses, I have some in the stock market, and none of that's performing well right now.
Right.
I'm probably going to be kind of tight with my wallet and making additional investments in this point in time. So that also makes the fundraising for new managers difficult.
Interesting. And in terms of size, right? So a new manager may think, oh, well, because what was the first fund, if you can disclose, first fund for MaC Ventures?
Oh yeah. So, well, first of all, cross culture was like 15 million, right? We
Okay.
thought we were going to raise 50, we raised 15. So it's not always, it doesn't always pan out the way you thought. MaC Fund One was 110 million. So yeah.
Yeah, and I like to ask the question about size because you could come out the gate and say, well, look, I want to do all of these things, right? I want to raise $100 million fund so we have enough management fees, first fund,
Mhm.
so we have enough management fees to pay our people, so we can build a consulting organization. Or, you've got all these big dreams, but then there's also kind of, well, what's really possible? Anything you've seen or, from other, new fund managers that, where they have been successful or where you'd say, in terms of fund size, or where you'd say, here's where I'd caution you?
Yeah, I mean, I think you got to be realistic in what you set out to raise for. Like, the guys over at, Collide Capital are good friends of mine. And I saw them on their journey and they set out with one target and they raised above that,
Mm-hmm.
right? It wasn't in that high period, by the way. So, so you got to understand that. But, they set a target that made sense for the fund construction that they had in mind, right? They had a certain number of companies, they had a certain size check that they wanted to write, they had a reserve strategy that they needed to implement, and they came up with a number based on those things, right? And this is how that construction model basically suggests how you intend to be successful in, with this fund. All right. And so it just has to make sense, right? And the LPs, they have to believe that you'll be able to deploy that vehicle in the
Right.
way that you're stating, right? So if you're like, oh, I'm gonna go and invest in, like, I'm gonna get stakes in, I don't know, Series C companies that are, unicorns at this point in time. How are you going to get allocation?
Right.
And, can you even write a big enough check with a $50 million fund to do that, for instance, right? It has to make sense. And you have to have access to the types of companies and founders that you're saying you're going to invest in. So yeah, so I say those are two groups that, that are on, fund one or fund two right now, and did a very good job of, speaking to the market, letting the market know what exactly they were trying to build, and convincing them that they could do it. And they were rewarded with, more capital than they came out looking for.
Yeah, it's always an interesting process just looking at that fundraise process, how it in some ways mirrors, a founder or a startup going out and fundraising, but also it can be a little bit more, whereas a founder, you may not define how each chunk of capital is going to be spent, but there's kind of a portfolio strategy when you're thinking of it from the perspective of a VC, and then for folks out there who may be VCs now, but not necessarily fund managers, how would you define the difference in your role as the fund manager versus someone who is making investments, but they're not necessarily sitting in the seat as the GP?
Yeah. The difference is either you're running a company or you're not, right? If you're a partner, your job is to go find deals, great deals that we otherwise are not seeing as a firm, win those deals, and then work with those founders to build great companies that produce solid outcomes for the firm.
Mhm.
If you're a general partner, and especially if you're a founding general partner or fund manager, you have to manage the business of that venture firm as well as do all the things that I just mentioned, right? So now you've got to, and ultimately you'll hire folks. Like we have a COO now to lead our operations, but you know, uh, I still have to work hand in hand with Jennifer, our COO, to make sure that, operations are going in the way that they need to. You got to worry about paying people. You got to worry about paying your vendors. You have to pick your vendors. You've got to, do things like select your CRM system, your system of record when it comes to the data repository for your portfolio companies. You've got to manage your fund administrator so that they're reporting properly out to your limited partners on a quarterly basis. You've got to select and work with your tax and audit teams at the end of the year to produce those things. You have to think about what's the career path for the junior folks within the firm. How do you keep them motivated and excited and happy? And how do you make sure they continue to learn, get access to the opportunities that they need in order to grow? How much do you pay them? When do you promote them? Like, is running a company while finding other companies to invest in and helping those companies to grow. So
Yeah.
it's a job. It's a real job.
A pretty long job description there. And also, I wanted to get your thoughts on some other kind of market trends, right? So, I think historically, startups, the ideal exit is, hey, we're going to build this thing, it's going to become a unicorn, and we're eventually going to IPO, right? We see that the market right now is not that great. Some folks are doing it, but overall, not the best market. But there are other exit opportunities, being strategics, another one being private equity. Is there kind of, you sit on several boards, work with several founders from this perspective. Is there a way, well, for you guys, do you plan for a particular type of exit? And then is there any guidance that you provide founders in how they think about building for an exit?
Yeah. So I mean, we underwrite every deal that we underwrite, we have to believe that it has the potential to return our fund, right? Say you got $100 million fund, this investment should have the ability to return $100 million to the fund, right?
Mhm.
So we start there. Not every company is going to IPO. And in fact, if you look at it, the vast majority of companies exit via M&A. And so that's likely what's going to happen. So one of the considerations is, well, if not IPO, well, first of all, can they scale? Let's assume like, yeah, we believe that. Then it's like, all right, well, they might not get there. So who would buy this company and or what entity would buy this company and how much could they potentially buy this company for? Right? Is another part of the calculus. In terms of like helping the companies through it, it's one foot in front of the other, right? Like I don't want companies focusing on the exit when they're a seed stage company. I
Right.
want them focusing on finding product market fit and scaling revenue and doing so in a profitable way. Like that's what our conversations are like, right? And
Mhm.
then down the road, if they're doing what they're supposed to be doing, which is creating value, folks will get interested. And now you start to see acquisition offers coming and things like that. But if you're focusing on the fundamentals of the business, like whatever your true KPIs are, and making sure that you're growing those, you're seeing significant growth in those. You're growing top line, which is revenue, at
Mhm.
a reasonable rate, but you're making money along the way. And your negative bottom line is becoming less and less negative and hopefully ultimately positive. Then we're doing our job.
Yeah. Excluding scenarios where you may fund a company in the seed stage and they're so capital efficient that they don't need to raise another round. Right. And ideal scenario. Okay. So I raise a seed round. Let's just call it 10 million. I raise a $10 million seed round. Now I need to get to the series A, but I also want to make sure that, as I get to the series A, I'm especially in this market where, capital is tight. We're pushing more towards capital efficient businesses. How much are you keying in on the founder's plan for how they use the 10 million And I'll leave it more broad there. But yeah, I'm curious, like as someone who's investing that money and the founder's asking you for money, how much are you keying in on their plan to get to this Series A stage?
Yeah, I mean, it's a huge part of it, right? Like, again, there's steps, right? We can't do this deal today and be thinking about what's going to happen at M&A or IPO, right?
Mhm.
Like, no, it's unrealistic in the vast majority of cases that a company is going to raise one round of funding
Right.
and then, run to profitability or to an exit. In all likelihood, they'll have to raise again. And so, what are the milestones within the next 18 to 24 months that this company needs to achieve in order to get to, we're seed investors. So, in order to
Mhm.
get to the Series A, right? Do we believe it's realistic? Right? Can they do it? And we are going to spend time on their operating plan, their forecast to see how they're spending to get there, right? And is
Mhm.
that spend reasonable? Is that spend profitable?
Right.
Right. So I mean, there's bottom line profitability, but there's gross margin, there's contribution margin, right? You want those to be positive as well. And so yeah, we're going to look at that. We're also going to look at, does it require a lot of, feet on the ground, a lot of humans to scale this thing,
Yeah.
or can it actually scale exponentially because of technology? That's also going to be a major consideration. So yeah, absolutely.
Yeah, I was curious if in the VC market things have changed. In 2021, if you raised $10 million, maybe there were fewer questions around how you spend it versus 2024. It's like, all right, well, we've got a lot more scrutiny, right? Just burning capital. We're less accepting of burning capital relative to if you were raising 3 years ago.
Yeah, no, again, 100%. I think we got into I like to say VC got drunk for a few years, and now we're kind of going through our hangovers to get back to where we should be. Like we always should have been thinking about, solid unit economics, right? And fundamentals of businesses. But yeah, for a while, because again, capital was free because
Mhm.
of interest rates, you know, VCs were like, other investors, whatever, they were just like, look, just grow. If you can
Right.
just show growth, I don't care if you're losing $2 for every dollar you're spending, but you're growing it at 5x, grow at 5x. And and it worked to a certain point, right? Then
Mhm.
you had a bunch of unicorns out there, right? Because they're being valued based on the growth, based on the
Right.
revenue. But they weren't looking at this thing is wildly inefficient
Mhm.
and actually it's losing money. So it's never at this current trajectory, it's never going to get to a place where this company can ever be self-sustainable.
Right.
It's always going to require additional investment,
Yeah.
right? And I think for a while, our industry was okay with that because that kept us relevant,
Mhm.
right? They got to keep coming back to us. We keep owning more in the company. But I think what we forgot about as an industry was that someone is ultimately going to have to buy this thing,
Mhm. Mhm.
and they're gonna care about whether or not it can become a profitable business, or it's gonna have to go in, onto the public markets.
Mhm.
And then the buyers of those stocks, they're definitely going to care if it's going to become profitable, right? You
Yeah.
buy stocks because you want to see the stock grow, and also you want to receive dividends, right? And the thing is not, if it's not spitting off free cash flow, like you're not going to get any.
Right.
So I think it was kind of short-sighted, and folks just got blinded, and we're as an industry, I think we're just competitive people, and so you're paying up to win certain deals and to have certain companies in your portfolio, and you're looking the other way in terms of some of these important things that are important, and you shouldn't be looking the other way on.
Yeah, it reminds me of kind of my experience on the software investing side, like looking at growth equity and private equity. It's like I see some of the high growth, earlier stage startups, right? And top line, oh, this is awesome. It went from 2 to 4 or 2 to 6, so it's great they grew 4 million, but they burned 10 million to get there. And so, I'd see the top line numbers and then I'd be excited hey, look at this deal. I get the question, well, how much have they raised? Oh, wow. Okay. So it's not efficient, right? So depending on the type of getting back to the conversation around exit, right? If another type of sponsor then does become an exit opportunity, it's then the question becomes, well, is this the type of deal or is the type of sponsor that we can exit to because they have their own return standards? And if not, then the VCs existing in the company have to be willing to take a return that may not return the fund, right? Which not all of them do, but not folks don't want to be in that scenario, I imagine.
Yeah, no, it's a game of home runs for sure, but you're not gonna have, in a 50 company portfolio, you're not gonna have 10 home runs, right?
Right.
You may have two, and then you're gonna have a bunch of base hits, which are, 2, 3x returns. Those 2, 3x return, they add up, right? But the goal is to return capital, more capital to your investors than you receive from them, right?
Right.
So
And then changing gears a little bit, I know we're coming up on time here, but artificial intelligence, AI, the buzz out right now, GTP 4.0 just came out. But I'm curious, as you think about, your portfolio companies and the companies that you are looking to invest in, what are your thoughts on AI? I mean, do they need to have an AI strategy of some sort? Is it better if they're AI native?
I don't think AI for AI's sake makes sense, right?
Uh-huh.
If AI can make your business more efficient, make it more relevant, etc., then I think it's something that you'd be remiss not to pursue, right? If you're just adding it on just to be able to say that, oh yeah, we have AI, then that's not really helping anyone. Yeah, I think there are tons of opportunities in AI across a myriad of verticals, and I think we're just scratching the surface in terms of what we'll ultimately see. But we've been investing in AI like 10 years, maybe longer, right? And across our respective, firms and then MaC. Yeah. And, there's so many new things coming up. And it's one of those things like you don't know until you know, actually, right?
Right.
There are going to be AI tools for the development of AI. Like there's so many different things that are coming up and are yet to come. It is very interesting, but it has to make sense for your business.
Right. Yeah, I think founders now are feeling the pressure. It's just from those that I speak to that they need to have some AI somewhere in the platform, somewhere in the pitch deck. But at least for you guys, it's not necessary. The business itself, the pain point that they're solving probably has to make more sense. And then the AI would be like, okay, yes.
Can you have a business without AI? Right? I think is where you start.
Mhm.
And is that is there a true need for that business? Is there a group of customers that are, pounding on the table or breaking down walls to get to this thing because they need it? That's where you start. And then I think AI it allows you to be more efficient. It allows you to run faster, jump higher, like all those things, right? So you have something that's needed, and now you can sprinkle something on top or integrate something inside it, and now you have this super performer, kind of a thing, right? That's how I look at it. Unless it's like I said, it's one of those companies that's helping improve the development of AI solutions and things
Mhm.
like that. So like software toolkits for AI and things like that. Well, then the business is AI, right?
Right.
But again, the what I said before is still true, right? Because someone really needs this. There are a
Mhm.
lot of companies that need to develop for and implement AI solutions. And if you have a company that can or a solution that can help do that, I think people will pay for that, right? But yeah, AI for the sake of AI, don't waste your time. Do it.
Right. Don't implement AI at the expense of growth.
Yeah.
Awesome. Well, yeah, I know we got a few minutes left, so I wanted to leave it for you to, I mean, anything, we're entering into slowly the second half of 2024, but anything kind of on the table that's exciting for MaC Ventures for yourself that you wanted to announce?
No, I mean, we're business as usual, right? We're finding great founders that we love working with in a number of different spaces. And it's really about finding, additional ways to support them in the development of what we hope will be category leading companies.
Mhm.
Yeah.
And how should founders who are interested in receiving investment, how should they submit their pitch? How should they get in contact?
Yeah, so we make it super easy for folks that we don't know. You just go to our website and we have a contact page and there's a form. You just fill it out and like we have team members that look at that and pick the ones that make sense for us and then they'll schedule calls and we'll see where it goes. We have made investments that came to us in that way. So I think a lot of times founders think that, oh, I'm just going to go to the website, it's going to be generic, I'm just going to be one of whatever, right? And sure, but if your company is interesting and you're building in a space that we care about and you're building a business that we believe we can be helpful to and also drive the outcome that we're looking for, we will get in touch and pursue investing with you.
Yeah, awesome. And one thing I would say is, for those founders who do, not just with MaC Ventures, but generally speaking, if you do hear back from an analyst, an associate, and not the partner, that's perfectly okay too, as long as it's someone within the firm. I know there have been stories where I only speak to partners, right? And that's not the person who's going to quarterback your deal. Well, they may quarterback it, but they're not going to champion. They're not the champion. They're not the person who's going to be your greatest advocate in terms of getting you to investment committee.
Sometimes that is true. I think you need to learn the culture of the firm, right? So, if our, analysts or junior partners, whatever you want to call them, are investigating a deal, like they're doing most of that work, for us. And they're going to be the ones in our Monday and our Thursday meetings, like, oh, I met this founder. Here's what's interesting about it. We should really dig in. So I wouldn't advise a founder to ignore an outreach from any of our folks. We take that very seriously. We're a very tight knit team. I mean, there are only 10 of us on our team, right? So we're very close knit, tight knit. Everyone's opinion is respected and welcomed. So you'd be doing yourself a disservice by not speaking with our junior folks.
All right, awesome. Well, Marlon, I appreciate you taking out the time to join us. I think you got a lot of helpful tips as well as insights into kind of your story, as well as what you've built out with MaC. So I appreciate you sharing with us.
Darius, thanks for having me on. This is fun.
Absolutely.